Hey there, Iguana Gang. Ivan here, and I've got some earth-shaking news that could rock your financial world. The Saudi-US petrodollar deal, a cornerstone of global finance for the past 50 years, has just expired. This isn't just some dry economic news. It's a seismic shift that could send ripples through your investment portfolio. In this video, I'm going to break down what the petrodollar system is, why its expiration matters, and most importantly, what it means for your hard-earned cash. We'll explore how this change could affect everything from the value of the US dollar to global oil prices, and even your retirement savings. But don't worry, I won't leave you hanging. I'll also share some strategies to help you navigate these choppy financial waters and potentially even profit from this major shift. So whether you're a seasoned investor or just starting out, this video is packed with crucial information you can't afford to miss. Buckle up, Iguana Gang, because we're about to dive deep into a financial game changer that could shape the future of global economics. Ready to get ahead of the curve? Let's dive in. Let's start with the basics. What exactly is the petrodollar? Well, it's not a fancy new cryptocurrency or anything like that. It's actually a system that's been in place since the 1970s. Basically, it means that oil is priced and traded in US dollars. This agreement between the US and Saudi Arabia has been a cornerstone of the global oil market for the past 50 years. The petrodollar system emerged in the aftermath of the 1973 oil crisis, when the US was looking for ways to stabilize the global oil market and strengthen its economic ties with oil-producing nations, particularly Saudi Arabia. Under this arrangement, Saudi Arabia agreed to price its oil exports exclusively in US dollars and invest its surplus oil revenues in US Treasury securities. In return, the US provided military protection and support to the kingdom. This deal had far-reaching consequences, as it led other OPEC nations to follow suit, effectively making the US dollar the dominant currency in global oil trade. The petrodollar system has played a crucial role in maintaining the US dollar's status as the world's primary reserve currency, giving the United States significant economic and geopolitical advantages. It has created a constant demand for US dollars in international markets, as countries need to hold dollar reserves to purchase oil. This has allowed the US to run large trade deficits without experiencing a major decline in the value of its currency. However, the system has also been criticized for giving the US too much economic power and for potentially contributing to global financial instability. Now, why does this matter? Well, it's given the US dollar a special status as the world's reserve currency, and that's a big deal. Think of it like this: if you want to buy oil, you need dollars. It doesn't matter if you're China, Germany, or Brazil, you need US dollars to purchase oil. This has created a huge demand for US dollars around the world, which has been great for the US economy. It's like having a golden ticket that everyone wants. This demand has allowed the US to run large trade deficits without tanking the value of its currency. It's also given the US significant economic and political leverage globally. Countries need to keep large reserves of US dollars to buy oil, which means they're essentially lending money to the US government by buying treasury bonds. This has helped keep US interest rates low and allowed the government to borrow more cheaply. Plus, because so many international transactions are conducted in dollars, the US has been able to use its financial system as a tool of foreign policy, imposing sanctions on countries by cutting them off from dollar-based transactions. So this petrodollar system has been a cornerstone of US economic power for decades, influencing everything from interest rates to foreign policy. But here's the kicker: this agreement has just expired. On June 9, 2024, Saudi Arabia decided not to renew it. This is a big deal, folks, and it's sending shockwaves through the global financial markets. For the first time in 50 years, Saudi Arabia is free to trade oil in currencies other than the US dollar. This opens up a whole new world of possibilities. We might start seeing oil transactions in Chinese Yuan, euros, or even cryptocurrencies like Bitcoin. It's not just about oil either. This change could have far-reaching effects on global trade, currency markets, and the balance of economic power. For example, countries that have been looking to reduce their dependence on the US dollar might see this as an opportunity to diversify their currency reserves. This could potentially weaken the dollar's position as the world's reserve currency. On the flip side, it could boost the status of other currencies, particularly the Chinese Yuan, which has been gaining ground in international trade. And let's not forget about the potential impact on oil prices. If oil starts being priced in multiple currencies, we could see increased volatility in the market as traders adjust to the new reality. It's a complex situation with no clear winners or losers yet, but one thing's for sure. The global economic landscape is shifting, and we're all going to feel the effects. Now you might be thinking, Iggy, what does this mean for me and my investments? Great question. This shift could potentially weaken the US dollar's position as the world's reserve currency, and that's something we all need to pay attention to. If the dollar loses some of its global dominance, we might see some significant changes in the financial landscape that could affect your portfolio. For starters, a weaker dollar could lead to higher inflation in the US, which means the purchasing power of your money might decrease. This could impact everything from the cost of your groceries to the value of your savings. On the flip side, a weaker dollar could make US exports more competitive on the global market, which might be good news if you're invested in companies that do a lot of international business. It's also worth considering how this might affect interest rates. If the demand for US dollars decreases, the Federal Reserve might need to raise interest rates to attract foreign investment, which could impact mortgage rates, credit card interest, and even the stock market. But don't panic! These changes won't happen overnight, and there are always opportunities in every market shift. If the demand for US dollars decreases globally, it could have far-reaching effects on the American economy. One of the most immediate impacts would likely be higher inflation in the United States. As the value of the dollar declines relative to other currencies, imported goods become more expensive, pushing up prices across the board. This inflationary pressure could prompt the Federal Reserve to raise interest rates in an effort to stabilize the currency and control price increases. Higher interest rates would have a ripple effect throughout the economy, affecting various sectors and financial instruments. For instance, mortgage rates would likely climb, making home ownership more expensive and potentially cooling the real estate market. The stock market might also experience volatility, as higher borrowing costs could impact corporate profits and investor sentiment. However, it's not all doom and gloom. A weaker dollar could actually benefit some sectors of the US economy. American exports would become more competitive in international markets, as foreign buyers would find US goods relatively cheaper. This could be a boon for US manufacturing companies, agricultural producers, and other export-oriented businesses, potentially leading to increased production, higher employment, and economic growth in these sectors. It's important to note that these effects are interconnected and can create complex feedback loops in the economy. For example, while a boost in exports might create jobs and stimulate growth, the higher inflation could erode some of those gains by increasing costs for businesses and reducing consumer purchasing power. But don't panic, this isn't going to happen overnight. The US dollar is still the most widely used currency in international trade, and that's not likely to change rapidly. In fact, as of now, the dollar accounts for about 60% of global foreign exchange reserves and is used in nearly 90% of international transactions. This dominance is deeply entrenched in global financial systems, from commodity pricing to international loans. Plus, the US economy is still the largest and most diverse in the world, which gives it a lot of stability. With a GDP of over $20 trillion and a robust, innovative private sector, the US continues to be a global economic powerhouse. Remember, change can bring opportunities as well as challenges. As the global economy evolves, new investment possibilities may open up. For instance, we might see increased opportunities in emerging markets or in currencies that gain prominence. The rise of digital currencies and blockchain technology could also reshape the financial landscape, offering new avenues for investment and trade. The key is to stay informed and adaptable. Keep an eye on global economic trends, diversify your investments, and be ready to adjust your strategy as the financial world shifts. While the dollar's role may change, smart investors will find ways to thrive in any economic environment. And there you have it, folks. The end of the Petrodollar agreement is a big deal, but remember, change brings opportunity. Keep your eyes open, stay informed, and don't panic. If you found this video helpful, smash that like button and subscribe to the Investing Iguana for more financial insights. Got questions? Drop them in the comments below. Until next time, this is Ivan, reminding you to stay smart with your money and keep swimming in those investment waters.